a very warm welcome back to all of you. I hope you've had a good break. I'm Arzesh Baki, and I'm the COO of Smartkarma. We've got a very exciting schedule for the rest of the day on this M&A track, starting off with what I'm sure will be a fascinating presentation focusing on deal trends in 2020 by Siew Kam from Dechert LLP. A quick intro on Siew Kam. Siew Kam is a mergers and acquisitions private equity venture capital partner at Dechert LLP, where she specializes in mergers and acquisitions with a significant background in cross-border transactions, private equity, and emerging growth venture capital, with an emphasis on Pan-Asian matters. If that weren't enough, she also works with private equity funds, venture capital funds, sovereign wealth funds, and corporate clients across all stages. She's qualified to practice law in England and Wales and Singapore, and she's been involved in some of the largest high-profile M&A, PE, and venture deals in APAC. And as if that weren't enough, she's also been named as one of the top 30 under 40 lawyers for private funds by PE International.
What I can't tell you is what stocks to pick in 2020. I mean, apart from the fact that I'll be committing insider trading. As an M&A lawyer, I don't pick the industries or companies to invest in, but my clients do. But I hope you don't turn off your screens. Because what I do have the benefit of is being part of an international private equity group, a really fantastic group in my view, at a firm known for private equity, and piecing what they do with what I do together in Southeast Asia gives me the benefit of being able to spot patterns. So as Azish said earlier today, what I want to talk about today is how deals will look like in the post-COVID-19 world. And, with that, I look back to the end of last year when I co-authored with a couple of my other partners, the Dechert Global Private Equity Outlook 2020 report. We surveyed 100 PE executives around the world, and they all are part of firms with at least $500 million of assets under management and are not first-time funds. I'm going to talk about 6 trends that we saw for 2020 pre-COVID-19. And I want to tell you why I think that COVID-19 has accelerated these trends. Okay, so the first one, in 2019, buyout activities, exit values, and global buyout fundraisers have all declined. And each of the respondents within those regions, they largely attributed it to geopolitical and macro factors, the 2020 elections, Brexit, the US-China trade war. So as a firm, we focus very much on the US attitude towards foreign direct investment, particularly coming out of China, which has to be vetted by the CFIUS. And post-COVID-19, Australia, Canada, India, UAE, Europe, they've all invoked or enhanced their policies along the same veins as well, supposedly to protect against the sweep up of their assets under fire sale. But actually, many suspect that COVID-19 is only a politically correct excuse to invoke these sorts of nationalistic policies anyway. And there's already a brewing level of, national interest, national security concerns, even before COVID-19. So now the relevant industries are not just limited to defense, but also in finance, healthcare, agriculture, technology, transport, and media. So I think in the post-COVID-19 world, reviewing these investment controls and the developing local and global, national and strategic concerns will take on a greater part of deal feasibility analysis. But to be honest, closer to home, many countries in Southeast Asia already have foreign ownership restrictions, and transaction structuring already has been taking on these restrictions in mind anyway. And just to complete this thought, I wanted to point out that, at least in the case of the US, foreign deal flow into the US still remains strong, and many deals actually continue to survive the CFIUS review process, including Chinese deals, in fact. What everyone reads about, in the press are the few that fail, and these few that fail get all the press. And the second trend is that despite private equity having built up quite a substantial war chest, $17 trillion, in fact, as at last count, a lot of the respondents still say that deploying their capital remains a struggle, particularly because of high valuations. And so they've all been open to creative approaches such as minority investments, partnering up with large corporates, take privates, carve out transactions. But I think the post-COVID-19 era raises even more uncertainty in respect of valuations. And so our clients and us are focusing even more on methods to bridge these valuation gaps. So a couple of trends, I guess, sub-trends within this trend. Firstly, we see a lot more usage of earnouts in our transactions today. For a very, very long time, earnouts have actually gone out of vogue because they're subject to a lot of litigation. Earnouts, maybe I'll spend a short period of time trying to describe what they are, but earnouts are just a portion of the consideration being deferred to a later time and will be paid, or the amount to be paid is subject to conditions being fulfilled, such as EBITDA or revenues. But you can imagine how hard that might be for some sellers to accept, because in a lot of these transactions, the sellers no longer have control of the company. So it's open to manipulation by the buyers. But the buyer would justifiably not accept any restrictions on the way that they want to conduct or run the business that they have bought. So a lot of thought is going to have to go into trying to balance these opposing views and at the same time utilize earnouts to bridge the valuation expectations that the sellers have, particularly in the post-COVID-19 world. The second sub-trend is that, and this is pre-COVID-19, as valuations and competitions for quality assets were quite intensified, a number of the private equity sponsors have been more willing to deploy capital in minority positions in order to gain, a toehold or a foot in the door in businesses that has attractive valuations. So for these companies, for investors, this is a very good way of getting a path to control, and for companies, this is a good way of getting access to capital without actually giving up too much control, too much equity, particularly at a time like this, when valuations are a little more suppressed. So because of that, I think, these minority positions are going to be, the minority positions are going to potentially accelerate in the post-COVID-19 world. I think in Southeast Asia, though, there's generally been more acceptance for these sorts of transactions. There's generally been more cross-pollination of VC techniques and special situation groups, distressed investment techniques in our private equity deals anyway. I guess in part because of our younger companies out here and a more diverse environment in Southeast Asia, from things like foreign ownership restrictions to tax. And of course, in Asia, we have a number of family groups who do not want to lose family control and want to build a legacy. So I think in the post-COVID-19 world, even outside of the Southeast Asian region, more private equity sponsors will start employing these sorts of techniques. I think we're likely to see the same types of structures that came out of SARS, post-tiger economy crisis in Southeast Asia, things like hybrid debt and equity instruments to enjoy debt downside and equity upsides. We might see non-price rounds right now, even in traditional private equity transactions, with a discount to the next price round to get closer towards a valuation once there is more certainty. And I think there might be preferred type of approaches to dividends and liquidation preference to deal with the enhanced risks that is perceived right now. We might even see in private equity transactions the much hated most favored nation clauses as well. In my conversations with Indian law firms and my English colleagues, they believe that this trend that I'm talking about is also making its way into their respective jurisdictions. So we'll see. Okay, so the third trend that we noted back in late 2019 was that public market transactions took on a larger share of private equity deals because of major reasons. The first one was that the euro and the pound devalued. The second one was that valuation multiples for public deals actually was on a downward trend to a point that in certain industries it was less than private assets. There was also quite a bit of shareholder activism in the market. And coupled with COVID-19, I think a natural consequence would be that there would be more take private or PIPE transactions. PIPE is private investment into public equity, typically minority type of activities. In this post-COVID-19 world, we continue to track depressed public company valuations, particularly, and liquidity issues as well, particularly among smaller cap companies. So these have actually created more opportunities for investments that might not have been available before the crisis. But the flip side of things, though, is that we're also tracking in the US, dozens of listed companies have adopted poison pills. And I think that trend will make its way into Asia as well, to the extent the local jurisdiction and regulations allow for poison pills. In addition to take privates, a number of the PE sponsors are actually considering the minority PIPE deals instead of take privates, especially because the funds themselves are suffering from the unavailability of debt financing for a larger take private deal. So from these PE investors' perspective, a PIPE deal can be their first step towards a larger and fuller buyout at some point in the future when debt financing becomes available to them again. There's also, to an extent, less reputational risk compared to a buyout, so that, where a PE shop could be seen as taking advantage of the pandemic situation. And from the issuer or listed company's perspective, getting a PIPE deal could give them access to capital and could give them a bit of a halo effect from, signaling to the market that they're bringing on new equity investors, despite the pandemic. One other trend that we're seeing right now is salvation capital from existing investors into portfolio companies. But salvation capital obviously comes with its own set of issues as well. I'm not going to touch on the technical issues, but a number of private equity funds might not have sufficient undrawn capital to call. They might not even have available credit lines. Some of these lines have been pulled. Some of these funds might even have reached the end of its fund life, or they might not have the mandate to make these additional follow-on or salvation investments into their portfolio. And so I think there is an emergence of a trend towards what Bain and Co. called the winner takes it all kind of dynamic. Towards late last year, we already saw a trend towards limited partners concentrating their investments into smaller numbers of private equity funds. So in many senses, I would say that the region's PE market has become quite sharply polarized between the large funds with strong track records that dominate PE activities versus some of the smaller, less experienced funds that might struggle to raise funds and achieve exits. So these larger funds, which were able to attract better and larger deals and more capital, are also going to, in the post-COVID-19 era, be able to provide salvation capital to its portfolio companies to help them survive COVID-19 better. So I think in the post-COVID-19 world, polarization is going to increase. At the end of last year, when we looked at our survey results, about a quarter of our respondents were already looking at long hold funds, so funds with longer life, and about half of them, if they haven't already been launching or establishing long hold funds, about half of them are thinking about it. But contrast that with, if I strip out the global figures and I look only at the Asian figures, there are only 2 funds in Asia who have raised long hold funds, although a number of the respondents in Asia said they were considering it. And I think the reason for that, and I guess to provide some context, this part of the world does not necessarily have a lot of patient capital from LPs. But yet we all know that there are difficulties in achieving exits within such a short period of time, especially in younger markets in Asia. And it doesn't necessarily make sense for investors in such funds to impose an exit on their investors when there are still such significant upsides. So as a result, our firm have been working on a number of fund restructurings over the course of the last couple of years. So when I looked at all of these in totality, and in addition, given the COVID-19, I think it does seem to suggest that APAC is likely to follow the global trend in respect of establishing more of these long hold funds. So I've talked about 4 trends. The 5th trend is just now stepping away from our mainstream private equity. We're seeing, as highlighted in our report, and I'm happy to share the report after this, we're seeing the extension of a global trend into Asia being the raising of private credit funds. The private credit funds actually have been an important part of the PE ecosystem globally because they fill this void that banks, more conservative banks, cannot fill. And they also fill a gap that private equity funds can't fill. And we're working with a number of private credit funds at the moment on their fundraisings. And just like companies pivoting their business during the COVID-19 era, funds are also doing the same. And the traditional distressed credit funds are now finding themselves in a pretty good position to provide credit to fundamentally, so not distressed companies anymore, but fundamentally good companies who have perhaps temporary liquidity issues, maybe through short-term bridging loans, because these companies who have been negotiating traditional financing have found that to be delayed because everyone's working from home, or rescue financings for those who's triggered technical or payment defaults on their existing debts, or generally just to provide alternative sources of financing to healthy companies whose refinancing lines have been cut off for no reason other than in respect of the financiers themselves. 6th And finally, we're almost near the end. A very welcome trend that we saw last year was impact investing. So we're also working on a number of impact funds at the moment. Impact funds are funds that are focused not purely on financial returns, but also on making a very positive impact on society, such as making investments in climate change, mitigation, affordable healthcare, and affordable education. So, in this post-COVID-19 world, I think impact investing is going to become the poster child of investments. And they have multiple names for it. It could be called COVID funds. And you might have heard of some of those. So to sum up, and I hope you're still awake, this is really, really the end, I promise. End of my presentation, not end of COVID-19. To sum up, what I said earlier was a number of private equity trends were already in the making before COVID-19, but COVID-19 has merely accelerated some of these trends. The trend towards nationalism versus globalization, the trend towards creative, nuanced, and customized capital solutions, the trend towards take-private pipe transactions, the trend towards the mega funds and long-haul funds, and the trend towards impact investments. So I'm going to pause here and give a few minutes. I think we have 8 minutes in total for interactive Q&A session, or Azish, if you have any questions.
So let's kick things off. I wanted to quickly touch on a few points that you raised. First one about earnouts. So it's a very strange time. There's no real precedence to the situation we find ourselves in. How do sellers really approach that conversation, which is, how do you calibrate the milestones in an earnout situation, for example, when you've been recently purchased or you're discussing being bought?
Well, I guess if you have recently been purchased and the transaction and deal terms have already been fully baked into your transaction documents, then it's hard to, or you wouldn't want to reopen those conversations. But one of the things, assuming you have already signed your SPA with the deal terms and purchase price baked in, is that there's another trend towards renegotiation of these transactions. We're seeing quite a number of those, particularly in the US, and even in my transactions, I'm seeing it out here as well. And they're not obviously reported in the press. In a lot of these transactions, investors or buyers are looking at things like MAC clause, material adverse change, material adverse effect, and some other due diligence outs, unsatisfactory due diligence, or they might look at, and I'll get to your question in a minute, but it'll look at other breaches of the agreements as a way to create leverage to renegotiate. And the renegotiation might not take the form of earnouts necessarily. It could just be a reduction in purchase price. But specifically to your question, let's say we are at the point where we're discussing earnouts in the purchase price. It's a little bit of an art and a science, and I know people talk about art and science a bit too much, but what I mean is that a number of the buyers would look at the valuation, and they would look at the multiple that they apply, and they would figure out if, based on the, or not be able to figure out, for that matter, what the delta between their valuation expectation or the valuation multiple is and what they expect it to drop to. And so you might say to the seller that, assuming that your earnings continue to be at a certain level for, say, 3 years in a row, or 2 years in a row, what have you, then I will pay you this additional amount. And as a seller, what you wouldn't want to do is structure it such that it's all or nothing, right? Such that for 2 years in a row, you have fantastic results, and the third year your results dip and it becomes
Yep.
all or nothing. So you
Yep.
might want to structure it such that it's a bit of a waterfall.
Right. Understood. Very valuable. Thank you, Siew Kam, for that. It was on my mind. Okay, I'm going to take a few questions from the audience. Just give me a second. Okay, this is a very brief question. Are PE firms still finding exits? I guess with the uncertainty in the stock markets, etc., and M&A, what happens to PE firms who have investments?
Yeah, that's a good question. I think exits are definitely slower. Having said that, I have some transactions where the target is in an industry that has benefited from the COVID-19. And so that's going, full steam ahead. But for some of the other funds, either they're reaching end of fund life, or where you have, say a redemption clause in your transaction documents after, say, 5 or 6 years from investment date that you're not able to get an exit. There are alternative sources that people are looking at. So the private credit funds that I was talking about, they're also looking at providing credit to management or to sponsors to redeem or buy out the private equity funds if they have these sort of redemption features or put option features in their initial investment documents. For some of the funds which are reaching their fund life, they are still going out there to try to do soft approaches, but they might have to consider fund restructurings. We talked about fund restructurings a little earlier, or maybe temporarily house some of these assets in continuation funds. So we're also looking at those with some of our clients.
Understood. We have time for one more question, so I will speed through this one. You mentioned a bit about salvation capital and that whole concept. Now, is there a risk that certain funds, or in this case, venture capitalists, they are going to be pumping more money into their portfolio companies without really taking a long, hard look at whether the company can survive this, crisis? Effectively, are they basically biased in that context? Any thoughts on that particular topic?
Well, I would certainly hope not. I would certainly hope that they have put some thought into it. I think more importantly, I don't know whether it's more importantly or not, but certainly an important factor that funds need to look at, putting aside the long-term viability of that business or that industry, because who's to know how long the COVID-19 will last for, and how countries and the macro and geopolitical issues will be like. But one thing we got to look at is whether the company's capital structure and financing documents would mean that the equity capital injection is simply going to go towards, I'm going to give an example, an immediate prepayment of their senior financing. In which case, if you're trying to pump in additional equity capital into a company to help them with their operations, let's say they're in a capital intensive industry, and if you find that your equity cure goes towards immediate prepayment of the debtors, that's not a good long-term solution, for example. Some might try to circumvent that and provide subordinated unsecured debt instead, but that might breach a number of the financial ratios, the financial covenants in their debt financing documents, which means their debt capital could be or refinance, or their revolver lines could be pulled, right? Yeah. So that's also not a good idea. So I think thought needs to be put not just into the commercial viability of the business, but on some of these existing capital and financing structure of the company.
Understood. Great. Thank you, Siew Kam. They're really illuminating. I think I'd like to extend this panel for longer, to be honest with you, but we've run out of time. Thank you again, Siew Kam, for your time, and thank you all the audience members for listening to this and for participating. I will hand the time back over to Amanda. Cheers. Thank you.
Thank you.